Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going on out there? It's August 2nd. I'm Frank Curzio, it's the Wall Street Unplugged podcast. To bring the headlines and tell you what's really moving these markets. In the mornings, I like watching Squawk Box for a reason. It's usually on that show. They have analysts on there, hedge fund managers, very important people. So they get the best guests a lot of the times. And they let them speak. They let them sit down on set and talk. And maybe they go to commercial and come back. And I always like it because you want to hear these guys. You want to hear the biggest hedge fund managers, the billionaires. You want to hear their opinion on what's going on. There's so much going on. Where they're positioning themselves. So I usually like the show. And today, it was freaking horrible. They had some really, really good guests on. Gary Gensler, you had Jay Clayton, Mario Gabelli. They had Andrew Sorkin. It's not Andrew Sorkin's fault, but he's interviewing Jay Clayton. And pretty good. But towards the end, finally with Jay Clayton, he starts talking about, he asks him one final question. And he starts talking about crypto. And says, what about the Ripple decision? What does that mean for crypto? And more importantly, what does that mean for the state of what's a security, what's a utility, and trading? And before he even gets a chance to answer, Jay Clayton, they start playing the music. And he's like, well, and he starts talking about how, related to ticket sales and what's the difference, if it's secure. And basically, in 30 seconds, he's like, oh, all right, well, thanks a lot. We got to go. Bye. Boom. And they're gone. And I'm like, what the hell? Like, that's a really good question you should ask before that. Could have been cool. I understand, you went over that with Gary Gensler earlier. But then you had Mario Gabelli on. I like Mario Gabelli. I like him a lot. He's brilliant. And he used to tour my dad back in the day and the Money Show and stuff like that. And what he's become and his funds are amazing. But he always has great insight. He's an entertaining guest. He's always been entertaining as a speaker. Great speaker. And they finally, they tell him the whole freaking show, Gabelli's coming again. So they put him on the end of the show, right? So you have to watch this thing for 3 freaking hours if you want to watch him. And they put him on with a couple minutes left. And he's banging out ideas. He's talking about, the used car market and General Auto Parts is 238 million used cars in the market and why this is so great for them. They have pricing power. He talks about the airline industry and what industries are going to perform regardless of the economy. He says 40,000 new planes next 20 years. Again, he's spitting out all this stuff and he knows that he has to, he's got just a couple minutes. So they're asking about more ideas, talk about, just trade, just tailwinds in the industry as well with Crane and Textron. But then he's going over Golden Entertainment. That's one of our portfolio holdings in hotels. But he's in the middle of going over these ideas. And he always has them backed with great data and opinion and stuff like that. You could disagree. And as he's shouting, again, they give him 3 minutes. And as he's good, they start playing the music and he's gone. They're like, well, we got to go now. Now we go to the next show. And that's why I love freaking podcasts. I mean, I hate that shit. Think about why are you watching this show? Is it really about the users or is it about your advertising dollars? Because by doing that, it's about your advertising dollars. When you have a good guest on, you want them on for a long time. You want them on where it benefits your guests. Right? That's the idea. You're giving your customers, these clients, great information, great ideas, and you're cutting them off saying, you know what, F you. We have to get our commercials in no matter what, and that's the business, and that's how you make money, but plan it a little bit fucking better. Let Gabelli or someone else, and maybe you don't like Gabelli. I happen to like him. I want to hear him a little bit more on what's going on. He doesn't do too many shows, and you should be out there a lot more. Everybody gets a little older as time goes on, but you want to hear these guys. If it's really about you and watching the show, that's what it should be about. Because I can tell you, I listen to CNBC on the way in. You have no idea how many commercials. The ticker on the bottom and all that stuff and that data is the greatest thing that ever happened. Because the commercials that they have, if I had to guess, the commercials on a normal show is probably maybe 20 minutes of the show, of an hour show. And you're looking at an hour show, it's got to be 35 minutes at least of commercials. I mean, they come in and even without having a guest on, and you don't really know is because you're looking at the tickers and you're going, it takes your attention away. There's commercials all day on CNBC, all day. And when you're driving, you hear that. Because you don't have that ticket to read, and it's wow. And then they'll come back, and then right after they come back from 5 minutes of commercial, they're they'll say, okay, and looking forward to the next hour. And by the way, and they'll have them say, well, here's who we're going to have. For 30 seconds, they come on, they go to commercial again. I get it. The advertising knowledge, you got to make money. But when you have someone on there, we want to listen to them, right? It isn't about like companies, or don't you exist to benefit your customers, right? To provide them a great service. You're not providing a great service by having Mario Gabelli on 2 minutes and cutting his ass off and doing the same. We're asking someone, right, who's relevant in the industry, Jay Clayton. And you're looking at all the regulatory authorities just sleeping at the wheel, all the bullshit and the politics behind crypto, when a regulation coming, how they lied to everybody, you're closing banks illegally that weren't fraudulent. I mean, all this stuff, that's a pretty cool topic. And what, you gave him like 30 seconds to answer that question? I mean, come on, you got to do better than that. You got to do better than that. That's why I love podcasts, because you interview people, you have them on the whole time, 20, 30 minutes. Yeah, whether you agree or not agree, you get to talk to them about their opinions and shut up and let them talk. It's pretty cool. That's why podcasts is just are so great. And I love this thing because, you just get into more interviews going forward, but at least it gives you a chance to really pick the minds of these people and learn from them compared to just having a minute and a half, 2 minutes, which is just terrible. Anyway, sorry about that little rant. A lot going on with the markets. We're in the middle of earnings season. And man, earnings are coming out like crazy. Past couple of days, what do we have? We have AMD, Norwegian, SolarEdge, Starbucks, not so good. The region was one that we did very, very well on. We sold it. I just felt like it, after 40% gains, we sold it, which is good. I just thought it got ahead of itself. A lot of the cruise lines are getting ahead of themselves. Match Group, Humana, CVS were positive from today. GM, decent numbers. But CEO, Mary Barra, is just like the Ford CEO did last year, is lying through her freaking teeth during the conference call, saying the slowdown EV sales was due to supply chain issues. That's 100% bullshit. That's bullshit. 100%. There's no supply chain concerns. I'm sorry. Very, very little supply chain concerns. Again, someone has been tracking this data the whole entire time through COVID, and the sources that have been tracking this stuff for 20 years. Even Goldman Sachs tracks it. There's others, and just shippers that track it. And you look at supply chain concerns where they hit all-time highs about a year and a half ago, 2 years ago. Now they're lower than 2008 levels. So she's going to go on there and she's going to say, remember, we're talking about Detroit. These people hate climate change, everything, but now you got them in EVs, and EVs are great. Why? Because the government's going to provide you money and hand you a check to build these things. But holy shit, due to inflation, we're going to lose a shitload of money every single time we produce these cars. So that's why you're seeing GM and Ford produce less cars this quarter compared to less car EVs, and produce more gas cars, because that's how they make their money. And they realize, like, whoa, not only are we getting a ton of recalls, we're not seeing demand. That's why Ford's lowering prices. They're not lowering prices to compete. You don't lower prices unless you can't sell your stuff. They can't sell them. They can't sell a Ford at 150. It's gotten bad reviews. There's some on the market. You could buy them right now on the resale markets. But don't come on and say supply chain concerns. That's a check the box to hedge yourself. Let me hedge. We don't want to go out there and say anything bad, because otherwise, the climate change crazy are going to come after us. And we want to say, hey, you know what? We're reducing EV sales because we're a corporation and our job is to make money for our shareholders. So let's produce more of these gas cars that are in massive demand right now, because people just don't, it's not EVs is a place in the market. It's cool. It makes sense. Some people like them. But the numbers of scaling and, come on, man. Holy cow, you're dialing that back a ton. You just can't make money. Unless you're Tesla, Rivian, those companies, pure plays. This is what they wake up and do, EVs. GM, Ford, Toyota, all these guys, Volkswagen. This isn't their primary business. They're trying to get into something, but they're trying to make money off it, and they're realizing, wow, even after we produce these things, and we don't have the technology to produce that many batteries right now, we don't have it, pay the Tesla, Rivian. But even when you do, you get these things out, they're like first generation, and you're recalling them. It just costs them a fortune and headaches. You can't even, how do you get these things repaired? Who knows how to repair these things? Tesla does. They've been in this industry for a while. But it's amazing. And just look, if you're going to lie, whatever, you say what you have to say. And I get it. I get why she's lying, because you can't say, hey, you know what? EVs don't make us money, so you know what? We're dialing down. No way. Ford would never say that. And GM, we're dialing down because we just can't make money. If Ford finally came out and said, hey, you know what? These things are just too expensive right now, but they're still producing them. But to say, hey, you know what, we're going to produce less, that would be pretty cool if they came out and said that. That'd be great for the shareholders, and the stock would surge because now they go back to making money and not losing a fortune like Ford and GM. Ford's going to lose, what, $3-4 billion on EVs this year? Crazy. The Daily I'm going to break down the winners, losers, companies report earnings this week, which is well over 100 companies. This is like prime. This week, next week. Got some of the big companies this week. I think it's Microsoft and Amazon reporting as well. So we'll break that down and find out, give you a recommendation like we always do, and break down the real winners and go into the numbers. But the much bigger story today, and the reason why the markets are down, selling off, and down pretty sharply. When's the last time you saw the NASDAQ down over 2%? I can't remember. It feels like it's up every single freaking day. I don't remember, seriously, when the NASDAQ was down more than 2%. It's down more than 2% as I'm doing this midday. Why? Because Fitch, credit agency, downgraded U.S., right? U.S. credit, which is resulting in not just a pullback here in U.S. equities, but globally. So they downgraded the U.S. long-term debt rating from AAA to AA+. And the rating downgrade was based on three things. Okay, it was expected, this is the expected fiscal deterioration over the next 3 years. That's number one. Number two, a high and growing general government debt burden. Makes sense. And the third, and this is the most important part in their report, is the erosion of governance based on repeated debt limit standoffs and last-minute resolutions. Okay, what Fitch says, okay, quote, the government lacks a medium-term fiscal framework unlike most peers and has a complex budgeting process, and also says how our politicians have made only limited progress in tackling medium-term challenges relating to rising Social Security, Medicare costs due to an aging population. Now, Fitch, I credit them for this call for several reasons. Okay, one, for telling the truth, which gets you in trouble. Right? If you tell the truth about COVID or what's going on, you got in trouble. Right? You got censored. Just again, you tell the truth, that's bad. You can't question anything. But they're telling the truth. They're right. That our politicians being assholes when it comes to the debt ceiling debates, back and forth. I mean, they don't really care. They're just getting what they want, little things, right? Within the bill that they're able to get. Another reason, it's calling out the U.S., which needs accountability. Our politicians have to be held accountable. There's no accountability. So what's them to stop spending since nothing happens to them? They keep spending. And I really, 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 really credit them, Fitch, because the last time this happened, this was S&P, right? The only time, this is the second time this happened in history, downgrade U.S. credit. In 2011, that was the last time it happened, when S&P, the other credit rating agency, cut its rating for the U.S., same thing, AAA, AA plus. And after they did that, the CEO of the company got fired 12 days later. And this is when every politician came out and said, these guys have no idea what they're talking about. And going. So, you know, Fitch got some balls to make a call like this, and good for them. Good for them. Now, I have access to this report, and it's being talked about, different opinions and stuff like that, but I think it's important we go over a little bit more of the data. And I'm not going to bore you. Trust me. This is really cool stuff. I'm a research analyst, and this is what I love to do. I mean, we all have opinions on something, and you can have an opinion on anything you want these days, but opinions are made stronger through research, through data, which, you know, helps support your opinion. So let's dig into this report. Because when we look at the numbers, Fitch forecasts a widening of deficits in 2024 and 2025. They say it's going to get worse. Amazing, really? It's going to get worse? Of course it's going to get worse. No accountability. So the largest deficits will be driven by weak 2024 GDP growth, a higher interest rate burden, and wider state and local government deficits. Now, when you look at the debt to GDP ratio for the U.S. is at 114% this year. Okay, that's well above pre-pandemic 2019 levels of 100%, 100.1% to be exact, right? We're 114%. Why are we so high? Why are we higher now than we were pre-pandemic? Okay, and before 2019, we never hit 100% debt GDP ratio. That's the highest it's ever been, record, as 100. Now we're at 114%. Let's put this in perspective, okay, because it's just a number. 114%. The U.S. ranks 9th as a country in terms of debt to GDP. That's out of 195 countries. And for those of you who be like, Frank, there's more than 195 countries. Well, there's 195 recognized by the UN. There's another 50-something that just call themselves countries, right? So the 195 countries that are considered countries by the UN. Now, let's take a look at the countries that are ranked worse than the U.S. in terms of debt GDP. Italy, terrible. Mozambique, am I saying that right? Venezuela, Greece, Japan, Lebanon. That's where we're at. You say, oh, we're totally different. We're totally different. It's not apples to apples comparison. Absolutely not. You're right. We have a stronger economy. It's much bigger, right? We have just in terms of income levels are much, much higher, much stronger. But you have to consider the class that we're in because it continues to get worse and worse and worse with no solution in sight. Similar to the Russia-Ukraine war. Is there actually something on the table that could end this war? I mean, is there a plan to say, hey, let's sit down? There's no plan to end it. The U.S. has no intentions of ending this or helping to end it. Why is that? Don't we want to end war when we want to? Why is there no plan in place? No matter what Russia does and says, there's no way. We just don't want to. Why don't we want to end it? It's interesting. I mean, things keep getting worse and worse and worse. But if you're really looking at the 114%, maybe this could put it in more perspective for you. Yemen's debt to GDP is 72%. Angola is 61%. El Salvador is 71%. Mongolia is 51%. We're at 114%. It's insane. It's insane, and we keep going higher and higher. And again, you could say, well, it's not apples comparison. No, but it means much, 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 much higher interest rate payments when you're looking at 32 trillion, over 32 trillion, pushing 33 trillion in debt that we have. And our debt to GDP ratio is projected to rise, like Fitch said, in 2024 and into 2025. And it's not just Fitch, because almost every economist that does research about this is forecasting the same thing for it to rise 2024, 2025. Now, Fitch does a good job putting in perspective, saying that the median ratio for assets that have its coveted AAA rating is 39%. So if you're looking at U.S. debt being at 114%, I mean, you're looking at 2.5, a little bit more than that, times higher than the assets that Fitch's, right, that they place on AAA, that they place a AAA rating on. That's how much higher it is, and that's why they're coming down in their rating. Right? So if you're looking at the debt and the median ratio, again, the median ratio for the AAA rating of those companies that have their best rating is 39%, we're at 114%. In fact, even if you look at AA, these companies have a debt ratio of 44%. Right? So obviously higher is a little bit of a lower rating, but even at AA, the U.S. debt ratio is 2x higher than the median asset they place the AA rating on. Seems like you're doing the U.S. a favor. Again, now, could you compare it to a corporation? Maybe not. I mean, the U.S., again, you look at the U.S., and you're thinking, this is the United States, Frank. We're the greatest country on earth. We always pay our debts. This downgrade is absolutely insane. At least that's what most economists are saying about it right now, including Lawrence Summers, who said, and I'm quoting, the U.S. faces serious long-run fiscal challenges, but the decision of a credit ratings agency today, as the economy looks stronger than expected, to downgrade the U.S. is bizarre and inept. That's what he said. This comes from the guy who deregulated, right, the derivatives market, supporting and pushing the Commodities Futures Moderation Act of 2000, which led to the financial crisis. I'm sure he didn't have those intentions when they passed it, but he said it's too much regulation on derivatives and whatever, and you didn't know what the hell these guys were doing. Nobody knew. Nobody knew to the extent. I had no clue. Even in mid-2008, you look at Geithner and Paulson had no idea what was going on. They had no idea it extended to GE, to AIG. They had no idea. This is mid-2008. They had no idea. And when I asked them about that, which is time where you could say, just like, Barney Frank and lowering the standards for homes where, you could buy a home and have adjustable rate mortgages, fine. I'm sure maybe your intentions were like, hey, we want to put people who can't really afford a house in a house, and I get it. But at least years later, admit that you were wrong. He did. He's like, no way I wasn't wrong. No freaking way. Of course, right? No way. Just like our politicians. Not one of them will ever admit that they were wrong. I mean, Cuomo won't admit that he was wrong in sending people. Again, we didn't know anything the full extent of COVID. And what happened? I mean, it was 10% of the people who got COVID were dying in New York. You know why? Because everyone who had COVID and spread in New York first and quickly, they put in nursing homes. Retirement homes. And that's the worst place you could put them. So a lot of people started dying. But even now, he's like, no, we did it right. Just admit, say, hey, you know what? That was on us. We didn't know. That's fine. No, you're not allowed that. And politicians and economists, no, never ever admit that you're wrong. Absolutely not. No way. Right? We also look at Lawrence Summers, who made a huge mistake during the Asian crisis in the 1990s, underestimating how high interest rates would cripple so many Asian countries. And to be fair, Lawrence Summers in mid-2022, when a lot of people didn't support much, much higher rates, he said that they have to go high, much, much higher to cool inflation. At least he was on board there. But, you look at Lawrence Summers, probably one of the best economists in history on paper. So his accolades and awards and stuff like that. In real life, I personally think he's a bum. That's my opinion. I don't like him. He's very arrogant and Again, thinks he knows a lot more and talks down. And again, there's lots of stories and shit like that through it. But it wasn't just Lawrence Summers, a ton of people. Janet Yellen came out, also disagreed immediately. Like her statement, obviously Fitch said they were going to publish this report. And at the same time they hit enter to publish it, Yellen came out with a statement. It was unbelievable. It's kind of like when you're short selling something and you come out with your report, and at the same time you hit enter, there's like 14 lawsuits on the company, because it's all coordinated through whatever the sites like Seeking Alpha and everybody else and CBS Market Watch and all this stuff, right? You just coordinate it where everyone, again, you give them a piece of everything, you give them the heads up on the short. Again, it's perfectly legal, it's perfectly fine. Take this position. Doesn't matter if you're going to only have that position for a little while, but again, it's just coordinated. So I know Fitch probably said, hey, this is what we're going to do. And Yellen had a prepared statement saying that this call is arbitrary and based on outdated data. Outdated data, really? Coming from a person who said just 3 months ago that the U.S. could run out of money if politicians don't agree to raise the debt ceiling. That's what she said. I can't make this shit up. She said that the U.S. is going to run out of money 3 months ago unless we raise the debt ceiling. But Fitch, outdated data. What is it, 3 months outdated? I mean, think about what Janet Yellen said. If a company said it will run out of money unless it could raise a significant amount of cash, it would not have a AAA rating on it. In fact, it would carry probably a double C rating from Fitch, which they define as a high probability of an issuer about to default. That's what she said 3 months ago. Now she said outdated data? Arbitrary? Don't agree with it? Again, Democrats, Republicans, other members of the U.S. Treasury also came out disagreeing with Fitch's downgrade, and they should. You know why? Because these are the assholes that are responsible for building our deficit to $33 trillion. Of course they're going to come out and say, what are you doing? Are you crazy? What are you doing? And of course, to where there's no plan in sight for how we're going to pay for Social Security, which is going to be depleted by 2033. How are we going to pay for that? How the U.S., think about the U.S. now paying $1 trillion just in interest on its debt due to these higher rates. That's right now. And the Fed, they said, hey, we're not done raising, and they can't be done. Did you see the job numbers? Housing, past couple of weeks, starting to tail off. Did you see what energy prices are? You know what you're paying for gas now? $3.69. It was $3. On average, it's about $3 and maybe 10 cents. It was the average nationally. It's $3.60, $3.70. This is in the past, month? Are you crazy? They're going to continue to raise, which means it's probably going to be even more in terms of just the interest on the payments. So I'm a research analyst. I started looking back a little bit. I said, how is a country different now than when S&P downgraded us, which was in August 2011? I think it was August 2011, maybe like a month before that. So they also downgraded U.S. debt, right? Credit to AA+, which occurred 4 days after the Congress voted to raise the debt ceiling. And I mentioned earlier, you know what happened then? 18 days later, S&P asked the CEO to step down, pretty much under pressure by the government, because you had Democrats, Republicans, U.S. Treasury criticizing the move, and they found like a mistake in it of $2 trillion or whatever, and they said, listen, this, in the scheme of things, it didn't really impact their research or whatever. Again, they try to tear it apart as much as they can. What a surprise. They're pissed off from the move. They should be, because they created it. We don't want to get this information out. People really don't understand what's going on, and people have been talking about this for such a long time. So it's not going to happen. Look at the debt ceiling. Debt ceiling was raised, and I think it was I think it was early August. Again, a couple days later, then we had the debt downgrade. And when they raised it to 16.7 trillion. Again, that was 2011, 16.7 trillion. So here we are 12 years later at 33 trillion. Makes you wonder why we have something called the debt ceiling. Ceiling means top. Why? I won't curse anymore. Why call it a ceiling when you're going to raise it every couple of years? This is the ultimate guarantee. If you're going to guarantee and bet something that's definitely going to happen, it's going to be that the government's going to raise the debt ceiling every couple of years. It's guaranteed. They have to. Or like Yellen said, the U.S. is going to run out of money. But Fitch is wrong on their call. Arbitrary. Based on outdated data. Okay. Good job, Yellen. But it is the ultimate guarantee, right? Our debts are going to continue to surge because there's no accountability. Nothing happens to politicians if they spend more money and lose it. I'll break that down more in a second. But back in 2011, so S&P downgraded their rating because they said elected officials remained wary of tackling the structural issues causing debt levels to rise significantly. So they blamed the politicians back then, saying these idiots cannot come together. It's such a pain in the ass, and it's going to continue. Back then, debt to GDP was at 89%. Again, where are we at? 112, 114%? And expected to rise at least over the next couple of years. Back in 2011, though, when S&P made this call, what was different? Interest rates was zero. Well, not zero, 0.04% to be exact, short-term rates. We're at 5.3% and likely going higher. This is a totally different animal. This is a different environment. Again, I used to make fun of people that said, hey, you know, the dollar will lose its reserve currency status, so you have nothing to worry about. You're seeing it. And maybe we won't use it for 10, 20 years or maybe ever, but it doesn't mean that other things aren't going to happen. Why do you think they're pushing central bank digital currencies? Why do you think they're pushing that? I've covered trends all my life. And trends, and if you want to be disruptive, they work when it benefits all parties. Let me ask you a question. Right now, how does central bank digital currencies benefit us? Benefits you. How does it benefit you? It doesn't. You don't worry about your money being stolen from a bank. It's insured. You don't worry about the transfer of payments. Yeah, you might have to pay $25, $30 a wire transfer. Okay, fine. Maybe we can lower that somehow, whatever. But it doesn't benefit. It's not benefiting you. What this is they want full 100% control. That's what they want. That's what central bank digital currencies are about. That's why would our Fed launch something like this? Why would they even entertain this idea? It doesn't benefit us. They can't say, well, it's better for the transfer of payments. No. It doesn't benefit us at all. It gives them a way to track and to control our spending. And that's what this is about, full control with no accountability. But what happened back in 2011, right after S&P 500, S&P credit ratings downgraded the U.S. debt? Over the next 2 months, the markets tanked 18%. It's even worse for the global markets. So something to think about, given that back then, though, the current state of economy was getting better, coming off of 2008, 2009, zero interest rates, pedal to the metal, QE all in. We don't have that now. Our current state of the economy, which Lawrence Summers is saying is stronger than expected, right? Being touted as super strong. Look at the manufacturing numbers starting to break down. Loan losses surging. Interest rates at the highest level in over 20 years. Over 6% of the families in America are living paycheck to paycheck. Really? You have the balls to go out there and say, hey, we have a stronger economy, and Fitch is crazy for saying this. Me, I applaud them. They have balls. They told the truth. And hopefully this puts our politicians on notice, which it won't. I mean, it's good to hope for that because they don't care. Because we got a bunch of assholes, and sorry I do have to curse, they're destroying America right now. And these guys are very, very smart. You could say, oh, these guys, they're not idiots. They're brilliant. I mean, they understand what their job is to get taxpayers' dollars. How do we get those taxpayer dollars everybody pays and get them into our own pocket? How do we do it? That's a politician's job. That's what they do. And one of the biggest scams that they do it with is climate change. And I know, I could see all of you who listen to this, who are Democrats or liberals or whatever, going, Frank, you're an asshole. How could you say that? Hear me out. Because most people believe in this, right? They want to make the world a better place for our children. Okay, find ways to lower our uses of fossil fuels. That's fine. I think a lot of people, most people are in that camp. I'm not in a camp for spending $5 trillion on renewables and lowering fossil fuel usage by 2% from 82% to 80%. $5 trillion? Why is it a scam? Because nobody's allowed to question how this money's being spent. No accountability. If we do, what's going to happen? The woke mob's going to crush you, hate the world, they'll come after your business. Say, oh, you hate the world, you hate climate change. You don't want to provide a better future for your children, next generation. You're anti-environment. They go after you. Just if you question it. Like, there's not a better way. Like, we couldn't spend $4 trillion? How did you lose $5 trillion? How did that happen? It's amazing that you can't ask that question. You're not allowed to. You get attacked. You're just finding better ways to spend some of this money because our deficits are out of control. I mean, you can't even offer nuclear as a solution, which it is a solution. And uranium's a devil, right? Even though statistically the safest, cleanest energy in the world, 24-hour baseload power, meaning that you don't need the wind to blow or the sun to be out to provide energy. And I forgot who it was who just did an amazing documentary, and he could barely get it shown at some of these private events. And this person, it was a liberal. I forgot who it was. I mean, George Lucas, I think, maybe. Just saying, why are we not using this? Like, and he went over everything and talked to people, interviewed people, and said, holy shit, like the narrative out there is 100% lying. It's false. About nuclear. Why not? That's a clean energy that we have access to. You have no idea how much uranium we have in the U.S. You know, the Exxon, all of the old school companies from the 70s and 80s, I mean, this is a big deal. It's almost a byproduct of what they're doing when it comes to oil and natural gas or whatever. But due to regulations, they were like, okay, we're not producing this stuff anymore. No way. But we know exactly where it is. There's a ton here, but yet we'll import the shit out of it, even though we're one of the largest users of uranium for electricity and nuclear. We'll import it, keep importing it, right, from everybody else. Pakistan, wherever. But no, don't produce it here. We're not allowed to, right? Climate change crazies. I mean, what do you want? Do you really want to lower the uses of fossil fuels? Do you really want to help? That's the solution. That makes sense. So if you want us to believe you, why not push that agenda? And why not question some of the money, trillions being spent, taxpayer dollars? You can't question it to try to save money. No accountability. That's why Warren Buffett, I love him. He had it right. I mean, they asked him about solving our debt crisis. And he said, I could do it in 5 minutes. I thought that was funny. And then when I heard the answer, he's right. He goes, you just pass a law that says anytime there's a deficit of more than 3% of GDP, all sitting members of Congress are ineligible for re-election. He's like, and you'll solve it in 2 seconds. Accountability. These guys have to be held accountable. Whether it's Donald Trump, whether it is the President of the United States, right? Biden, doesn't matter. You have to be held accountable. And these guys right now are just running wild, doing whatever they want, spending whatever they want. I mean, these are our taxpayer dollars. And the system is, hey, we hire the best person that's going to represent, all right, are they really on both sides, if you're Democrat, Republican? Are they really representing your ideas? Are they? But I love that statement from Buffett. And the Fitch downgrade, good for them. And look, I think it's a big deal because it shows the world, I'm not sure if it's reminding them, but it's showing them how our debt levels of the biggest country are unsustainable. And it's going to get a lot worse. And I can't even say before it gets better because there's no sign it's going to get better. I truly believe most people here in the U.S. and abroad, they don't have an idea of what's coming. I don't think they understand what, $1 trillion in interest rate payments. No plan in place to solve the crisis. Constant raising of the debt ceilings. You can't do this constantly. Not at this level. And to go about it like it's no big deal as you're raising rates by the fastest pace in the Fed era. I mean, something's going to break. We've never been worse as a nation in terms of debt than where we are right this second. Something to think about. Man, that's a bad note to end on. All right, this is even worse. I'll end on a worse note. And this is Steve Cohen. Okay, this is worse. This way, that's not the worst thing that you hear. I hate ending the podcast where it's so bad, but that's bad just to end it there. But Steve Cohen, owner of the Mets, just basically fired sale the whole team. Said, okay, we spent a shitload of money, number one spending, and now we're getting rid of everyone. But they got 2 great pitchers, which is Max Scherzer and Justin Verlander. Both of them underperformed, and he got rid of them. So you say what's worse in the country right now? It's probably Steve Cohen's pockets because he's paying over $80 million for these guys now to play on other teams this year. There you go. It should make you feel better about everything I said. But this Fitch thing's a big deal. Let's see. It's hurting the markets. It's just a reminder. It's a tap on the shoulder to say, hey, you know what? This shit's getting real right now. And you need to do something about it. I'm glad they highlighted it. They told the truth. The numbers make sense. But come on, for everyone to say, no, you're crazy. Do we really deserve a AAA rating? Do we? Are you crazy? So it's interesting. Let's see what happens with the markets. Again, we're waiting for something to just tilt it where the put-call ratio is at the lowest levels. You're looking at basically the bears ran and hid. I told you about this a couple weeks ago when you have Mike Wilson, who's the biggest bear in the market, apologizing, mea culpa. You have Tom Lee, biggest bull on the market, that's just like, high fiving everyone, Squawk Box. Yeah, this is great. I mean, these are signs. These are signs that, hey, we're close. When everyone's leaning to one side, everyone was extremely, extremely bearish. November, December, January. Right now, everyone was extremely, extremely bullish, leaning to one side. This is just a tap on the shoulder and a reminder to say, hey, you know what? Things aren't that great, so be careful. And you need to be careful in this market. So guys, questions, comments here. Feel free to email me at frankcurzioresearch.com. That's frank@curzioresearch.com. And I'll see you guys tomorrow on Wall Street Unplugged Premium. Take care.